if I'm helping the founder understand what this thing is and making sure that they explain to their employee in a way that they understand what it is, then I'm helping everyone achieve their goals with kind of one fell swoop. It's attraction to the company, it's retention, it's well-being for the employee, it's happy employees, which helps the company grow. So I mean, the bottom line there is just like, yeah, it's important to understand what these things are and what you're really offering them.
Well, thank you all for joining us tonight. Our special guest is Husch Blackwell. We are talking all things early stage equity. How do we set those things up? How do we execute on our options? And kind of how we're going to structure it is we'll do some time of just panel and asking some questions. And then a bulk at the end is just going to be Q&A. So be thinking about all of the burning questions that you have about equity for startups. But without further ado, let's start off with some softballs, some easy questions. How about just a little bit about Husch Blackwell and kind of how you guys usually interact with startups, especially at the early stages?
We're going to see a lot of this. Us just like trying to figure out who's going to handle question, but yeah. So Husch is a full service law firm. That's the spiel. It has everything that you would need a law firm from on the corporate side, startup through exit, public company securities, IPO. We handle all that on the corporate side, also handle everything on the litigation side. We are corporate lawyers, as you guys probably surmise. So how we interact with startups is, I mean, every single day we're working with startup companies. That's what we both do basically full time. Maybe I think Casey's probably more exclusively startup, and I probably still have a little bit in my practice of more traditional M&A type deals, so mergers and acquisitions, full exits for more mature companies. But we're interacting with startups from, hey, how do I start my business? We need to get a filing to like legally form the business. I'm the sole owner. To, hey, we all four just quit our jobs. Let's get this thing going and go all for it. To, hey, we've been around and it's time to start getting serious about our legal needs and we're going to raise some money. Can you guys help us out? So, I mean, we see all of it.
Excellent. Anything to add, Casey?
It's a great job, Gabriel.
Appreciate it.
So one thing Gabriel did mention, we have 20 or 25 offices around the country now. We have some offices that are really focused on startup work, including our office here in Omaha. Gabriel came up from our Kansas City office. Both are really involved in the startup community, going to events, sponsoring events, just trying to be, part of the startup community and educate people, get involved, do whatever we can to, build and support entrepreneurship. And so some of the things we typically do is getting involved with startup incubators or startup accelerators, doing office hours, kind of doing legal one-on-ones, similar to what kind of you're here today. We just like to be there and answer questions. We like to think that we're smart, and so answering questions is what we'd like to do, I guess. So
excellent. So in terms of, when you first start out, let's say you have a napkin idea, and you're thinking about, in your terms, starting to get serious about it. At what stage do you really start to think about equity, or in your experience, when do you see founders start to really consider equity and kind of how that plays a role in the startup life cycle?
Well, how much money is in the founder's checking account is a big factor. How risky the venture is a big factor. Debt in the long run is always going to be cheaper than equity. So, the first conversation is, do you want to sell equity at all? Or can we go get, are we going to bootstrap this thing, or what? It's a highly variable answer because of the circumstances that the founder can find themselves in. But I mean, at the end of the day, if this is something that you're going to pursue and you don't have the money, or it's too risky to whatever life circumstances or whatever, it's time to raise some funds. And that's usually the part where we come in, on the equity side of things. Obviously we help on debt offerings and things like that for early stage, but most of it's equity. And like I like to be in the cap table and helping you manage the cap table, helping you understand what it looks like now, what you want to do is going to make it look like tomorrow.
Yeah, and just to maybe go a little bit earlier in the life cycle, the first conversation we normally have around equity is before the company's even formed. Obviously, if there's one founder, it's pretty easy. Multiple founders, you start to talk about, well, let's just say there's 3 founders. Are we going to be 1/3, 1/3, 1/3? That works for some people and others it doesn't. What are the roles going to be? How much time are you putting into this? What kind of, background do you have in this space? Are you going to have or is everybody going to have a full-time job? Is one person going to have a full-time job and 2 people are taking this on full-time? There's a lot of different factors that go into it, but it's really important to figure that out before you, jump into filing the paperwork and getting, operating agreements or shareholder agreements signed. Once you do that, it's kind of set in stone to some degree. It's really hard to tell a founder, you got 1/3 of the company, but you haven't done anything in 3 months. We want to buy you out, or something like that. It's just really important to think about the expectations for each of the founders going in, so that you can divvy up the equity accordingly. And we could also kind of jump into the conversation around vesting. I'm gonna let Gabriel talk about that for founders.
Yeah, I mean, the part that I've run into, Casey's saying it's really hard to have a conversation with your founder, with the co-founder or something like that, where you're like, hey, you have too much equity or you don't have enough equity, or what are we going to do? Which is another issue from taxes are real, and oftentimes your equity, unless it's an option or something like that, your equity is property that you own. So we can't just fudge with the numbers all the time, because we're creating taxable events every time equity gets issued. So to Casey's point, it's definitely better and cheaper to put your ducks in a row and understand what you're getting yourself into, so that we don't have to start thinking creatively about how to change the position we're in to get into a different one. But yeah, on the vesting front, we've seen one, company that we're working with who is about to raise some money. We helped them right whenever they were starting, and they were all working full time. This was a dream that they had, the 4 of them. They were going to jump into it, but because of life circumstances, only 2 could do it full time, 2 had to do it part time, or 1 kept a full time job for, I don't know, the last 18 months or something like that, and is about to come on full time, I think. So, we had to talk about that. It's okay, well, your equity has to be subject to these vesting terms. My equity is not going to be subject to these vesting terms, because there has to be upside for me in the short term for the additional risks I'm taking on. But at the same time, how does the economic side of things with the equity impact the voting side of things, and who's going to control this company moving forward? Are you, because you're the one who's jumping in full time now, are you going to be the one that gets to make all decisions for the company? Because that kind of makes me anxious. So you get creative in how the documents are structured, and when the financial components and the voting components of those documents start kicking in or vesting over time, just generally.
So when you have a couple of partners on the vesting side, I know it's fairly common, it seems like, when you have just one partner or 2 partners to just go 50-50 or 1/3 apiece. Is it common to have a vesting schedule for co-founders? I know certainly for employees, it's really common to have a vesting schedule. just to make sure that you're there long term. But for co-founders, is that fairly common?
Yeah. So yes, and so particularly, we work primarily with companies that are going to seek investment in the future, and most investors are going to require vesting for the founders, or what they call the key employees. So that when they invest, let's just call it $500,000 in the company, they don't just walk away. And they say, oh, well, I have my 25% of the company. I'm just going to, good luck, take a vacation or go get another job or whatever. So they say, you're going to subject your shares to vesting, which we keep throwing this term around. I don't know if everybody here knows what that means, but vesting is this concept of you are given your shares. Let's say you get 100 shares of the company at the beginning, but you have to stay on with the company performing your role as an employee or officer or whatever for a specific amount of time. And that's typically, let's just call it 4 years. You'll get 25% of that 100 shares will vest, meaning if you leave after a year, you get to keep 25% or 25 shares, but you're not going to get the whole 100 that you got at the beginning. And so we do recommend any company that is going to seek venture funding that they just from the get-go set up a vesting schedule for their founders. And frankly, for any company that has multiple founders, we really recommend it. You don't know where life's going to take each of the founders. And so just set it up so that there's not a fight later on about, well, how much are these shares worth? Do we have to go get an appraisal to buy them out? Essentially blackmailing one another can get kind of nasty. Think of it like a business divorce is what we sometimes call it. I mean, it is kind of like that. So you just kind of set the ground rules from the beginning, and it's not super complicated if you're thinking about it the right way, and you just have the conversations about what your roles are, what the expectations of one another are, and you set it up so that if somebody does leave, it's clear from the get-go what they're going to walk away with.
Yeah, and not only what they're going to walk away with, but it also becomes clear to you, the remaining founder, what the path forward is for the company, right? Like, we don't want you, our goal is to put you in a position so that if you ask the question, what happens if my co-founder quits tomorrow? We have a very clear answer. I remember very shortly after I started in Kansas City, my career, I guess, we were talking about like capitalizing an LLC. One person was putting in the money, one person was going to do the work, and they were going to go 50-50. Like, that makes sense to me, right? Someone's doing all the money, someone's doing all the work. And I had a partner come in, Jason, came into my office. He's like, okay, well, what if the person who's doing all the work quits tomorrow? How these documents are drafted? It's like, well, they get half the money that the person just put in, right? Like, capitalize the business. Here's all the cash. We own all of it 50-50. I just lost half that cash, right? So, yeah, I mean, yeah, you want to be able to answer the question of what happens if a co-founder quits tomorrow. It's not always going to be in attention like a purposeful decision. As we've talked about life circumstances, you don't know what's going to happen.
Yeah. Casey, you mentioned 4 years as you were talking. Is that kind of a standard? Is that something that you go for? Or, if it isn't, what are the things or what are the factors that you might consider as you're setting somebody's vesting schedule?
Yeah, so 4 years is what we call industry standard in the venture space. So venture meaning you're going to try to raise money from venture capital, which they have kind of standard terms that they're going to try to push onto the startup. And that includes a 4-year vesting schedule for not only the founders, but also for every employee that comes on afterwards that's going to get equity. It does change for other companies that are not going to go down that path. I'm working on a project right now where, let's just call it a gym, very similar to what Gabriel just mentioned. One person's going to put up the money, one person's going to run the gym. we're not going to put a standard 4-year vesting schedule on that. It's just a different circumstance. They're never going to try to raise money from venture capital. It's really about making sure that person's committed, to the company, and they're going to, set everything up, do the training, and maybe they get a new operator to move in. But it's not really a 4-year plan like it would be for venture. So it just really depends on the business, the industry, but really what the roles are going to be as well.
And it doesn't have to be time-based vesting. We help out a lot with performance-based vesting. So instead of tying it to you being there for a year, we tie it to you achieving a milestone of some kind, whether that's company. You can do company hits a certain amount of revenue. If you want it to be more targeted, think about it like sales, where they're getting a commission, right? It's like, well, if you bring in a certain amount of dollars, or if we ship a certain amount of products, whatever it might be, then you're going to vest X%. And then here's the next milestone, and here's the next milestone.
Makes sense. So in terms of, let's kind of get out of the track of the co-founders. Once you hire your first employee, somebody that's you don't consider a co-founder in the business, how does that change the game? I know, especially in startups, this is a lot of the audience is people that are in startups or like thinking about getting into it, and could be employees. How does that change the narrative when you talk about equity, option pools? I know that's a thing, but let's kind of start there, just from a high level.
So, all right. So, option.
I like the you talk and then I supplement. That seems to be working for here.
So I guess I'll start with the concept of an option pool. We typically call it an equity incentive plan or an equity incentive pool. You might have heard of stock option pools or plans. Some people use the term ESOP, which has a very specific meaning in our world. But this is called the stock pool or the option pool. You set this up so that you're reserving a specific amount of shares for employees or other service providers, independent contractors, advisors, influencers, whoever you might need to bring on to do work for you, but you're not going to pay fully in cash. So you're going to pay the partly in equity. So at the get-go, you're typically reserving in between 10 and 20% of your equity for this pool. And as you grow, you're giving usually less and less of that pool to new employees. So for example, you might give your employee number 1% of the company, or 3% of the company, and then number 10, you might be down to like 0.5 or 0.3. So just as you're going, the company's obviously growing, it's worth more money. So you're giving less and less of that away. But for your first hire, depending on where you're at, whether you've raised money or not, or whether you have, significant assets, we typically do what's called a restricted stock award. So as I kind of alluded to before, you're effectively giving them shares, saying, here's 100 shares, subject to these vesting conditions. And the IRS is going to look at that and say, that's the same as giving them cash. We just have to determine what the value of those shares are. So there's a number of different ways, but you have to determine what the fair market value of those shares are. You have to typically want to disclose that to the IRS, and you can file what's called a Section 83B election to effectively prepay your taxes for those shares. Fairly complex process. I'm happy to go into more, but the idea behind that is you actually are paying taxes because you're receiving property, and most employees only want to do that when the company is not very valuable because the impact is so high. You actually have to pay cash in at the end of the year that you're receiving that award. When the company grows in value, we typically switch it from restricted stock, where you're getting the property, to stock options, where you're getting a right to buy property for a specific price. So pretty big change from the employee's perspective. They no longer own the shares. They just have a right to buy the property. But with that, there is no tax impact immediately. So they're not paying taxes in, and they don't have to make any declarations to the IRS.
When would that change be? When you go from a restricted stock where you receive property, you receive the actual shares versus an option to buy them?
It is dependent a little bit on the employee. So oftentimes there's kind of a window in the enterprise value where we might offer both of them depending on the employee's choice, because there is benefits to them even if they do have to pay up front. There's long-term benefits to having restricted stock. But we're normally seeing companies with an enterprise value of $1 million to $3 or $5 million are switching over to stock options. So typically after there's been a round of funding, we're switching over to stock options.
So kind of the seed stage.
Yes,
is where you might see that.
Yeah, I mean, Kate, it's a hard question. Long into practice, we're still asking tax experts at the firm how best to handle a lot of these awards because, it can get really complicated. I think the direct answer to the question on what does it mean, like, okay, you hire your first employee, everything becomes a little bit more real. All of a sudden now you have all the stuff that you're worried about on your personal behalf and the company's behalf, just like normal, but now you're adding a whole new thing into the mix that now you're worried about the employee as well. And one thing that I always like to stress to founders whenever we're talking about equity, especially early stage, whenever there's more options for how you can structure things, is it could be a marketing tool for your company to be able to offer equity in an efficient for the employee, like a tax efficient way for the employee, and a way that still helps you keep your cap table really clean, right? Like, I know if Casey and I were both at startups and we were at lunch, I'm sure that because we're nerds or whatever, we'd be talking about like, okay, well, what's in your stock option plan? What's in your stock option? And how our companies treat us is going to matter to us. And there are ways to structure equity that's better for the company, and there's ways to structure equity that's better for the employee. And I think it's important to think about those things about, at least understanding what those options are. I make an argument to founders all the time that, okay, yeah, it might be tax advantageous for the employee here and less tax advantageous for you, but I think having good employees is also advantageous for you. And allowing us to help you think about how to structure these awards with the vesting schedule, what's in the plan, what the circumstances are for you forfeiting your rights, what the circumstances are for us being able to buy these shares back, helping you think about all these things and being able to communicate it clearly to your employees means that your employees are going to be hopefully more appreciative of the equity that they have because they understand it. And at the end of the day, it's a retention tool, right? Like that's why we're offering it to them. We don't have the cash. This is a retention. We're giving this to you to help retain you as an employee. And I think you can't achieve those goals if you don't understand what you're offering them.
Yeah. What's, kind of a good way to describe, I'm sure there's some people in the audience that have either gone to work for startups and received options or had the option to do that, or might in the future go and work for a company and receive options. Just from a very high level, like how do I even read the verbiage? What's kind of the quick and dirty version of what I receive? How would I even know that there's this option, and what would I be looking at?
I always start with the title of the document, personally. I hope it says stock option award or stock option agreement. But yeah, I guess if the question is just generally how do we structure options or whatever, it's we're giving you the right today to purchase a certain number of in a C Corp shares of the company in the future at a determined price. That's it. So the goal there is that we're issuing, if the company's shares are worth $1 per share today and we issue 100 options today, we're going to say the strike price on these or the price at which you can exercise these is $1. And hopefully, if you help the company grow, then the share price per share is going to be greater than that when you exercise it. So you can pay $1 for this, and you can get $2 worth of property in return. That's when the IRS comes in at that point, to Casey's earlier points about when you actually own the property. But I mean, if that's a question on just how generally are we structuring options, that's it. And that's why they're a retention tool. That's why they're an incentive tool, because we hope that if we all achieve our goals and grow the company, then I'm going to have the right to something that is worth a lot more than I'm going to have to pay to get it.
So if I do receive the stock option agreement, outside of just the numbers, is there anything that I should be watching out for or, you know, kind of looking for in that document? I imagine for a lot of people, that would be the first time that they're ever seeing something like that. Is there, you know, any points that I would really want to look out for in that document?
Sure. So it's probably a good idea to call an attorney at this point. Well, hopefully you have a friend who can help out a little bit. These documents are fairly complex, and they're typically, you're going to receive a stock option award agreement. And then there's also this equity incentive plan that I talked about before. Your stock option award might be 3 pages, but it's subject to all the rules and regulations of this equity incentive plan, which might be 20 or 30 pages. And they work together. So you need to look at them and read them together. But Jake, to your point, the most important thing is usually right up front. It's, I'm getting this many shares. This is the price. That's what everybody looks at. And it's like 90% of their attention is right there. But something you really do need to look at is what are the ways, you know, I could lose these, I guess. If the company fires me or lays me off or I quit, what happens? Is there a difference between a for-cause termination or cause? If there is, what is a cause event? Is it if I, you know, don't show up to work one day, or is it if I, you know, do something that's horrible, like, you know, steal the company's IP or something like that? So I think you really want to look at those distinctions. But for the most part, they are fairly standardized. So I think the real point is make sure you understand, okay, I'm getting 100,000 shares. What does that mean? You know, see if you can talk to the founder or the CEO or whoever's hiring you. What is the total capitalization of the company? So if I'm getting 100,000 shares, is that 1%? Is it 10%? Just try to get an understanding of what that means relative to the rest of the company. Because those numbers look great. But you know, you're not buying shares in Microsoft or something. So you need to understand the bigger picture. But then, you know, devil's in the details. So looking at the termination provisions is something important. And if there's anything like, there's oftentimes like a non-compete or a non-solicitation in there. So taking a look at those and seeing what kind of restrictive covenants was what we call them, things you can't do that are in that agreement.
Anecdote. I have a friend who's at a company in St. Louis that I think they're on their like Series D or something like that, and he was issued options, and we were just talking about life or whatever, and his wife's pregnant, so they're about to have the second kid, and he was thinking about quitting, but now the second kid's coming, and so all the life stuff that happens. And he's like, well, now I can't quit because second kid's coming, and they have a really nice paternity leave policy, so I'm gonna like at least stick around until like the paternity leave kicks in. I'm like, sounds good. And he was like, but when I come back, I'm thinking like, this is how much time I'll have left on my vesting in order to vest my next cliff or whatever he said, in order to get to his next vesting point that he wanted to get to. And he's like, I don't know if I can do it. Like, I don't know if I can stick around that long. And later on in the conversation, he talked about his boss was open to him being part-time, blah, 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 blah. But again, he was worried about the vesting. And I'm like, well, have you like read the plan? Because if the plan doesn't say anything about you being a full-time employee, it just says you need to be an employee in good standing or whatever it might say, then your options are going to continue to vest even though you're going down to part-time or whatever. So it's just an anecdote for like how it can have real-world impacts what we're actually putting in this plan for not only you, the company, right? Like, is that fine with you as the founder? I don't know. Maybe, maybe not. Is it cool with the... But I think to Casey's point, it comes down to how do these things vest? How do I lose them? And all that stuff is going to be in the plan. but I thought that he was like, oh, well, I've never thought about that, I was like, yeah, because you don't spend 24 hours a day in these documents. So
exciting.
Yeah.
So, Casey, I think you had mentioned like a range or just a couple of numbers. As a general rule of thumb, and Gabriel, you would know this too. At an early stage, maybe for like their first 5 employees, what's like a reasonable amount of equity to give somebody? And then maybe from, 5 to 50, what's another, range that is reasonable? Because I know certainly as you grow and certainly as you have, a certain number of employees or the capitalization grows for the company, the amount of equity shrinks that you would receive as an employee down to tenths, maybe hundreds of shares or percentages. So what would be reasonable given those ranges, like first 5 employees?
Yeah, I'll start by saying it depends, and that's a lawyer's favorite statement, so sorry. But it does depend on the industry. It depends on the stage of the company, what role this person's coming into. Are they, a junior developer, or are they coming on as the chief marketing officer? But I think one resource, if you're really interested in this, that you should check out is Carta. I don't work for them. I have no affiliation, but they have a great database. They can show you what other companies historically have done, and so you can look at that. I think it's a really great resource. But, first, let's say 5 employees, we're typically talking between 0.5% up to maybe 3%. If you're bringing on somebody that's effectively like a co-founder or executive type role, that might go up a little bit higher. But when you start talking like employees 10 to 50, you are really looking at 0.05% to 0.25, depending on the role. And really that's where it really comes down to, is like, how badly do you need this employee? Is this the best person for your job? I mean, that's what it's there for. It's an incentive, particularly if you're not able to meet the market salary for that person. You just, give them more equity. But it's bigger than that too. Some of the companies I work with either pair their equity to their salary, like the salary as well. So they try to match the value of their salary to equity based on the company's current value or some multiple thereof. Others do it based on the position. And so if you are in, a management level or an executive level or a VP level, you're getting different bands. It really depends. So, makes sense. Yeah, I can give you kind of general advice, but there's so many factors that go into it. It's hard to say.
Yeah. So as you go, let's say you go all the way through the vesting as an employee, you find a new opportunity at a different place. How do I go and exercise my option? Like what is the, easy way to describe how do I actually go and cash in?
Hopefully the company has communicated that to you at some point, but there also will be an exhibit to there should be an exhibit to your option award agreement, which hopefully is called an option award agreement. And it will say, here's a form of exercise notice. It'll have a bunch of blanks in there because at the time we're signing the option, we don't know when this is going to be exercised. Fill that bad boy out and take it to someone, hopefully, I don't know, take it to your boss. I don't know who you take it to. CEO. Hopefully they told you to take it to this point. Yeah, CEO on the, yeah. There's an exhibit. It's the short answer.
So, yeah, you have your strike price, meaning the price that you're going to pay per share. You have, say, again, let's use 100,000 shares. Let's say it's $1 per share. Hopefully you just happen to have $100,000 laying around. Some people do, and they're able to do that, buy those shares. And then now you're that's your property. You own that, those shares. But oftentimes there is what's called a net exercise. Cashless exercise. It's a fairly complicated thing to describe, but effectively, you're going to not get your 100,000 shares. They're going to take the price of, your exercise price, $1. Let's say the company is now worth $2. Your shares are. You get 50,000 shares, and you forfeit or give back the 50,000. So that's you net out at $100,000 worth of value.
So you don't have to come up with cash. You just.
Gotcha. You're basically taking that amount out of what you would receive.
Correct.
In value. Okay. That makes sense. And the last question I have before we go to Q&A is, and this might be a little complex, but I know a lot of employees and co-founders oftentimes when they go to sell, when they get acquired, when they sell the business, they're often shocked at the difference in value. They let's say you came on as an early employee, you received 5%, you're, a high level and you're there the whole time. You go to sell and they think I'm getting 5% of $1 million. I should be doing pretty good here. I'm going to get 50 grand, but it's oftentimes much less than that. Can you talk into, what factors might be at play there? Why might it be, much less than that?
So I'm going to start on a different direction. I'm going to let Casey maybe more directly answer the question. I'm kind of curious to see your Casey's thoughts too on not only how to communicate that value at the time that the equity is awarded, but how do you make sure like at the end of the day, it's an incentive tool, it's a retention tool. How do you make sure that your employees still understand the value over time? And I'm kind of curious to hear your thoughts on that, because he mentioned something earlier on, whenever you get issued this award, you might want to talk to your CEO and ask what the company capitalization is, because you're getting 5 million shares or 1 million shares or 50,000 shares or whatever. But if there's 10 million shares outstanding or more, whatever, right? If you don't have the bottom of that fraction, then you just don't know what percent of the company that you own. And why I said I want to go in a different direction was something I touched on earlier, which is if it's an incentive tool and a retention tool and the employee doesn't understand what they're getting, or if you as the founder can't explain to them what you're giving because you yourself don't understand it, then it basically defeats the entire purpose of the instrument, right? You're just giving away free money at that point because no one understands. Sometimes, though, we go the other direction, which is what you're talking about. It's a great incentive tool because they think that it's worth more than it actually is, right? Mm-hmm. And I've had conversations with founders before where you don't always cash out at a corporate transaction event like that where you're just selling the whole company. Like, especially most of the time I have this conversation with like LLCs or whatever, where we issue profits interest, which actually give them right to operational income. And what I say is like, okay, this is an early employee. They don't know what this is. And we both are in agreement that they think it's worth more than it actually is. They're going to vest. You're going to be 3 years down the road. And then all of a sudden, when you still depend on them, right? Like, you still need this employee. And then they're going to find out that it's not what it actually is. I'm upset if I'm the employee, right? So I've got I've got a tough conversation with my founder. I'm going to leave the company out of principle because I can't trust you anymore, even though I can still be productive and this is the company I want to be at. So like, that's what I kind of harp on every time I have an equity, and why I really like being in the cap table, because if I'm helping the founder understand what this thing is and making sure that they explain it to their employee in a way that they understand what it is, then I'm helping everyone achieve their goals with kind of one fell swoop. It's attraction to the company, it's retention, it's well-being for the employee, it's happy employees, which helps the company grow. So I mean, the bottom line there is just like, it's important to understand what these things are and what you're really offering them. Casey now is going to talk about how to do that.
I'm not going to talk about that, actually. I'm gonna answer Jake's question, but no, I'm gonna keep using the same example. Let's say you get 100,000 shares. You have options. You have common stock, which is, I don't even know how to explain that. it is going to be junior in payment to any preferred stock or senior stock. And that's really where this comes in, is you have different classes of stock. Investors will typically buy what's called preferred stock. One of the most important aspects of that preferred stock is they get paid first. So let's say the company sells for $1 million. This employee has 10% because I'm just going to use easy numbers. They have 100,000 shares. The company has 1 million shares. The investors own 500,000 shares. So they have 50% of the company. But before the common stock gets $1, the preferred gets all their money back, at least before anything happens. So that's really where it comes in, particularly if the company doesn't have a tremendous exit that's way above expectations. Let's say it's below where the company raised money at, a valuation of $2 million, and now they're selling for $1 million. The investors are getting all their money back, and the common stock holders, the founders, the employees are getting what's left over. And so you can definitely get a lot less than, if you own 10% of the company, you could get 1% of the proceeds of the company sale, because the investors are getting all the money out the top. See, I won't get into like paying off debt, but that's another way that you could you could not get paid what you think you're going to get paid. If the company has outstanding debt, that's usually paid off should always get paid off before any of the investors or common stock gets anything.
Makes sense. Nice. Yeah, I want to open up for questions. I'm sure there's a ton of questions in the audience. Just raise your hand or shout them out.
You go for it. Let's say like you're getting ready to maybe take on debt or equity, from like a financial reporting perspective or metrics perspective. Like, is there a framework or something that you should have prepared or ready to present? Kind of something same as obviously financial statements and tax documents, but
when you're going to raise money either through debt or equity, the question is whether you need to have like financials prepared, or what kind of financials to prepare,
or like what's the presentation material that we're looking for. So like whenever I was in high school, they always told me it was a business,
a 40-page business.
Yeah,
plan?
exactly. It's like, do we still need the business plan?
Yeah, it's just like pretty overwhelming. Like,
so I guess it's the question: what kind of presentation or materials do you need to prepare before you go to raise money?
Yeah.
Am I missing the question?
No, I think that's it.
Okay.
From like a financial perspective, what additional things, like what documents would I need, or what should I be showing my potential investors?
So I'll focus on like the equity side. It's a little bit easier for me to answer because that's what I deal with more. Your typical introduction is going to be very basic. I typically recommend like a 10-page slide, and that's it. It's very simple. What is the company? Who works? Who's the key people there? What you've historically done, but more like, what are your expectations? What's your plan? What are your projections? What's your, whether it's a 1 year, 3 year, 5 year, like, give me what, as an investor, show me how you're going to make me money. That's what I want to see. Your next one, they're interested now. You might get even into the diligence phase, which is when they're looking at all the details of the company, looking at all the legal documents, looking at detailed financials. You're giving them all your, monthly statements. At that point, you might have a more detailed, pitch deck, if you will. That's, 25, slides or something. But it really depends. Some investors just don't care. Like, they just want to, they're investing in a founder. They're saying, I like the business idea. I like you. I think I can trust you. You've had success in the past, whether it's school or, a previous, startup you did, or in your career in another role. I think, most of it is in the founder. Business idea comes second. And, financial projections are something you're really pulling out of thin air. So it's nice to have at the early stage. but it's really just to get the investor to pique their interest and, get the conversation going.
I'd just ask. I mean, I made a joke about needing, business plan as well. I remember whenever I had to draft a business plan for a class or whatever. I've never seen anyone who has had a business plan actually. So I've never seen a business plan in my legal practice right now. Yeah, no, I don't want to read. You don't want to put it together, and I don't want to read it. I don't look at your business plan.
I've seen a couple, like with somebody, they wanted to do a seed round, and they sent me a 50-page slide deck and asked my thoughts, and I said, I don't have,
yeah, no one was.
I've got through 10 slides, and I have no idea what you're doing. Mm-hmm. So,
yeah, just ask
and get to the point.
Yeah, just ask.
Even on the lending side, you see the business plan, 5 to 7 pages, unless you're super complex. If somebody wants more, they're going to ask for it. It's not. We're not letting them.
Yeah. Yeah.
A good pitch deck or a short business plan, not a doubt or
That's great.
and sleep.
Correct.
I kind of want to piggyback up that question on just like from the equity perspective. Like, I'm a founder that's going to raise a first round of funding, and maybe I haven't set up my C corp yet, or haven't like incorporated quite yet, or just have an LLC and am navigating that transition. Like, how should I be thinking about the equity that I'm offering to the investor, and how much I'm keeping myself, and like, how do I protect my own equity and options pool? Like, can you just talk to that a little bit on that really early stage?
And Kurt?
Well, I mean, it goes back to, for me, it goes back to the checking account a little bit, right? It's like, what do you think the company is worth? How much money do you need, right? Like, if you, this is the same thing as, how, I don't actually remember what the question was earlier when I was talking about the checking account. Or I guess we asked about how do you think about taking on equity? When do you think about taking on equity? When do you think about taking on debt? And the answer to that question is the same answer to this question on, well, now I've chosen equity, how much do I want to offer, right? And it's just going to be a push and pull on how much cash do you need to continue operating the business based on however much cash you're burning, and what do you think the company is worth? Because if it's a lowball offer on the valuation of the company, but you really need the cash, or the company's not going to be worth anything because it's not going to be around, I mean, those are the kind of factors that you're going to be thinking about whenever you see the term sheet on, see a term sheet from an investor. And this is something that, Casey and I were on a call yesterday with a client talking about this exact thing. And this particular client said, I was like, hey, how are you doing? He's like, well, I'm kind of in a weird place because I got a term sheet that said my company is worth X million dollars, but I'm kind of disappointed. And I'm like, okay, well, first of all, congratulations. All right. But, and that's an offer that's probably going to get accepted because they need the cash. So
how does that work? Like, super, super early before there's like really a valuation. Like, obviously, like, you're still assuming some kind of future valuation on that. I just see a lot of founders get into a lot of hot water because they give away too much equity too early, and then it's really hard to claw back any of that for future investors or for employees.
Especially with like safe agreements and those kind of things that happen before there's ever like a set dollar.
Yeah. So I think the important thing there is to really step back and look at the big picture. I hate to say, like, talk to your attorney because I'm an attorney and I'm going to try to
they talk to me.
Talk to me. Or somebody that's been through the process, or, a financial advisor, or somebody that kind of has a better grasp on the big picture, because you're grinding day in, day out. And you're like, I need this money. I'm kind of accepting whatever terms I'm given. And oftentimes you don't have a big network of, you're not, talking to 10 different investors who want to invest in your company. You're taking kind of the first offer that's coming to you. And it might be, I'm just going to give a simple example. They are valuing your company at $1 million, and they're going to give you $500,000 for your first investment, $500,000 is a lot of money. But they're buying 50% of your company. And most people are like, man, I didn't really think about that. We get some of those, like, after they didn't talk to an attorney, didn't talk to an advisor or anything, but they've grown really fast. But now they have 50% of the company between 4 people. And it's difficult for them to bring on new employees because that's going to dilute them. And frankly, it's going to be very difficult for them to get another investor. So there's somewhat guide rails or, expectations that in each round, you shouldn't really be giving up more than, let's say, 20% of your company. There's exceptions to that rule, but, 10 to 20% is pretty normal. Maybe 25% on the top end. After that, you're really risking losing the most important, like losing the interest of the most important people, the founders. If they're not interested and incentivized to continue on because they're going to get such a small payday at the end, the company's not going to go anywhere. And the investors see that down the road, and they're not going to invest in your company. So I think just when you get that first term sheet or your conversation around how much money they're going to invest versus what they're going to value the company at, take a step back, breathe, sleep on it. But I wanted to specifically answer that. I don't know which one you guys said, the SAFE. The same, a SAFE, if people aren't familiar, SAFE is an acronym for Simple Agreement for Future Equity. It's a very quick and easy way to sell future equity, and to get money in the bank. I mean, you could sign a form agreement, but you can print one offline and sign it in 10 minutes. It's not going to be that much different than what your lawyers are going to provide, frankly. But
you'll understand it.
But you'll understand it. But the important part is, there's a few key pieces that you put in there, including the actual investment amount and typically the valuation cap. And so it's not a difficult calculation, but dividing the investment amount by the valuation cap will tell you what that investor's buying. If they're investing $500,000 at $1 million valuation cap, they just bought 50% of your company. So just really, got to pay attention to those details. There's not a lot of variables, but the variables that are there are very important.
And can you just describe real quick, like, when does that, you said it's for future equity. When does the future happen?
Yeah. So there's with the SAFE, which, again, it's a fairly new concept in the legal world because we move slowly. It has 3 different conversion, events. The first being what is typically thought of as the most common is going to be your next equity financing. So you get a SAFE for $500,000 at your $1 million valuation cap, and then later, you grow the company and you have a seed round or a Series A. That SAFE converts into 50% of the equity. The 2 other ones is a dissolution event, which is essentially you're going bankrupt or you're winding up the company. You're not going to, be successful. You have $10,000 left in the bank. You're winding the company up. And then the third one is going to be an exit event. You instead of raising that seed round or A round, you just sell the company, and they're going to get at least their money back before you get $1. So they're going to get their $500,000, or 50% of the proceeds, whichever is greater.
Awesome.
Yeah. So for startups, lawyers are great assets, but they are not exactly cheap. And a lot of times at day 0, day 1, they don't have a lot of funding to work with. What are the major events at the beginning stages of whether someone's buying a business or organizing ideas to go and talk to a lawyer? Because you don't want to spend more time than you need to at that.
Yeah, I want to let Gabriel answer this question in detail or directly. But I would say, and I say this every time somebody will listen to me, try to find try to find a lawyer that you can make friends with, that you can, and it doesn't necessarily have to be a venture lawyer, but somebody that knows a little bit about the space that could just issue spot for you. Like, hey, I'm going through this thing. is this the time to talk to a lawyer? Because it's really fact specific each time. Offer to buy them beers or take them out to lunch. You should be surprised. I'm being optimistic here, but you should be surprised. Like a lot of lawyers, myself, and I know Gabriel included, I'm happy to go and just grab lunch with somebody for free, kind of talk through what they're going through. And I'll tell them like, hey, this is going to cost a lot of money if you want us to handle this. There might be you need a lawyer, but there might be a cheaper one, or if that's more appropriate on circumstances, or you know what, there's some pretty basic stuff you can find online. Don't spend your money. This isn't the right time. So I'll start there, but then let Gabriel answer the question more.
Yeah, I mean, I say something similar to people when they're looking for a lawyer. I know Casey just said a guiding principle could be like someone that you like is probably a good place to start. But what I tell people is you don't have to come to me, you don't have to come to Casey, you don't have to come to our firm, but please find someone who does this thing for a living. Because, you know, I drive by the billboards all the time, my hometown, small hometown, where it's like, oh yeah, you know, I do divorce and bankruptcy and like, I'll help you with your Series A. I'm like, there's enough to keep us busy. Like, this is what we do full time, and we still learn every day, and we're still asking questions and still engaged because the law changes, and it's too much to keep up with for someone to do more than their niche area and do it really well. So that's my how do I look for an attorney advice for anyone who might be looking for an attorney, is just find someone who does that specific thing. As for, you know, hey, I just formed a company, what are the major like milestones to go get an attorney? To Casey's point, we understand where companies are, and we don't want the company to have go bankrupt an hour in because they, you know what I mean? Like, we want the company to be successful too, because we want to be your lawyer, and you know, like that's we're looking for a long-term relationship too. So like leverage that and go ask. But anytime you're hiring an employee, you know, before the employee, anytime you're issuing equity, please just like talk to someone. And for an LLC, that means an operating agreement, because an operating agreement is going to have an exhibit at the end that has the schedule, and it's going to say how much of the LLC you own. So before you sign that first operating agreement, if you don't want us to look at the rest of the terms of the operating agreement, we can try to turn a blind eye to some stuff as best we can. But like that's equity in an operating agreement on the LLC side of things. If you're starting a C Corp, that original, there should be, you probably won't be, but there should be an organizational consent where we talk about who is going to own the equity in the C Corp. We've kind of harped on it the whole time, and this is an equity, you know, this kind of like an equity dialogue, but it's hard to call that stuff back. It only gets more expensive, like by more factors, it only gets more expensive as time goes on to try to clean this stuff up. So getting it right on the equity side at the beginning is much, much, much more important. But like state of formation, like right the day you start, like the state of formation, like where am I going to do it and stuff like that, like that stuff we're not gonna harp on too much. But
just as kind of a rule of thumb to add to that, there's 2 points I think that you need to like form your company. And I don't know if that's exactly the question you're asking, but to protect yourself individually, if you are bringing any money in the door, you're selling a product or service, you need to have a company. You need to have a business bank account. It is the best insurance you're ever going to buy. It's cheaper than any business insurance you're going to buy. It's just forming a company. And the second is if you are going to have, you know, co-founders, you need to form a company and to be able to split up the equity. And then I guess your third one is that you're going to bring in any investment, have to have that set up. So, but then it's just variable, but depending on the industry, you know, you might need terms and conditions and privacy policies. If you're a SaaS company, you need all that kind of stuff set up. It's really dependent on the industry.
I will say maybe a guiding light here is if you're the only owner of the company, it is a lot harder to screw something up in a way that is not fixable later, because we haven't issued equity, you know. So if you're the only person, you could probably pinch more pennies on the legal costs. But if you got other people in there, like this goes back to the conversation we had earlier where it's like, yeah, someone's doing the work and someone's putting in the cash, and I didn't think about a vesting schedule. So if they quit tomorrow, they have half the money I just put in the LLC. And it's like can get out of hand quickly if you have other people involved. So maybe that's the rules. Like if other people are involved, maybe talk to them.
Why are you seeing when equity conversation comes into consideration for like consultants and fractional CFOs, CTOs, whatever it might be?
It's a great question. When I'm advising companies that are engaging with, I just call them generally consultants. But I would say fractional professionals are a little different. Depends on what kind of fractional we're talking about. I have some companies that I work with that are 50% with one company. I treat them effectively as an employee. Maybe it's 50% of what they would if they were full-time from an equity perspective, but it just depends. Are they taking a major cut on their hourly rate? If so, they're getting more equity. But the big difference, I think, is we typically don't have a cliff. So I didn't really talk about this, but on a vesting schedule for traditional employees, there's usually a 1-year cliff where if you don't stay at the company for a full year, you get 0 if you walk away or are fired. For more professionals, consultants, advisors, they're providing value day one. They're not expected to necessarily stay on for 4 years. They're usually on a monthly vesting schedule. So if they say in a month, now they're getting some equity, and the equity is not usually on a 4-year schedule, it's on a 2-year schedule. So it's going to be spread over 24 months. As you might expect, they're not full-time employees. They're usually getting a little smaller percentage. But there's actually a company out there that tried to standardize this. It's called a FAST agreement. If you look that up, they provide some metrics. It's like depending on the advisor's skill level and experience, they put them in 3 different buckets. Are you an expert? Are you kind of intermediate or beginner advisor? And then how much time they're spending with the company, whether it's, I don't know if it's, I think it's like 5 hours a month, 20 hours a month, 40 hours a month, something like that. They just kind of slot you into whether it's 0.1 up to 1%. And it's kind of a good starting point for conversations. But yeah, all of the equity incentive plans that we work on are definitely, accept or are available to advisors and consultants. And frankly, I think it's some of the best use of your equity early on that you can do as a founder.
It's both common, but is it out of that employee options pool, or would it be in just general common stock? Typically.
Good question. So at the end of the day, the common is going to be common. Common is common, usually. You can set them up to have different classes, like Class A common stock and Class B, with different voting rights or different economic rights, but 90% of companies are just common is common. And they're coming, regardless of whether they're employee or advisor, they're coming out of the same pool. So they are going to be subject to the equity incentive plan in most cases.
And I just want to focus on one thing Casey said there at the end, subject to the equity incentive plan. That's kind of the key there, is because especially early, if you haven't taken on funding, you don't have another board member involved, you're in control of the company, you can issue additional equity anytime you want to. My company has 9 million shares. I want my company to have 10 million shares. Okay, cool. We'll sign the document, right? It's there. But the difference between just issuing common stock not out of the plan and issuing stock out of the plan is the stock out of the plan is subject to the plan. So you already have the guardrails in place for how to call that equity back if something happens, right? And if you issue it out of the plan, it better be in a document, that specific document, that it's outside of the plan. All the clawback, all the protections, all that stuff needs to be in that specific document because it's not subject to the plan. And at that early stage, that's really the key distinction between whether the common stock is issued out of the plan or not. After you take on funding, after you have another board member, after the management gets a little trickier on getting stuff done, the plan has other benefits. But I'm assuming before we funded here. That's kind of the key thing to keep in mind.
Tender. As you talk a lot in various ways about LLC versus C Corp. I'm sure a lot of people are familiar with the differences, but what are the main reasons that you would pick one and be over another as a startup or a small business? And then what are the advantages in terms of equity for both types, or disadvantages?
So we get this question all the time, and people have different opinions on it. The answer in our space, in our little field, is most of the time you want to be a Delaware C Corp because that's what investors want you to be. So, and we want investors' money. So we're basically just going to do what they want us to do on that regard. On a more basic level, let's say you don't have the goal of taking on funding. If you do have the goal of taking on funding, it's easier to be a Delaware C Corp. There's obviously tax disadvantages to that, but if that's the long-term goal, that's what we're going to do. We convert entities all the time from LLCs to Delaware C Corps because they want to take on investor funds, and the investors want them to be a Delaware C Corp. But taking that all aside and just saying in a vacuum, which one I don't know if I'm going to take on funding. I don't know if I'm not. An LLC to start is more tax advantageous than a C Corp because a C Corp is subject to double taxation and LLC is not. I would say unless you know that you want to take on funding and you have a specific reason to be a C Corp, then it makes a lot more sense to be an LLC also because the tax advantages, because they're more flexible. We can kind of just put whatever we want to in the operating agreement. It makes a lot more sense at that stage. I think Casey winced when I said whatever we want to. But subject to some statutory default rules, whatever we want to. So yeah, I mean, that's how I would think about it is if I don't have a pressing reason to be a C Corp, like there's investor funding, I want the one that's going to make me the most money. And the easy answer there is the one that I pay the least amount of taxes in. And since an LLC is not subject to double taxation, I think that's usually the biggest differentiator between the two. Now, let's say you're going to bootstrap something that's not going to scale despite the name, and you're just going to, it's going to be a family-run business. You're setting this up. You want to run this thing for 40 years, and if it generates a bunch of, money internally, great, I'm going to be the owner. A lot of times we'll see people set up as S Corps because you get to, with respect to your employee withholdings, you can pay yourself a reasonable salary, and your reasonable salary is subject to your employee withholdings, but anything above that is not. Whereas in an LLC, it's all subject to your withholdings. So there's tax games you can play on the S Corp side too. A lot. So I could talk about this for a long time, and I try my hardest on say it depends, but it really it's very contextual what the company's goals are, how much of your decisions are going to be tax driven, and how much of them are going to be flexibility driven, co-founder driven, et cetera, et cetera, et cetera. I just got it. Yeah, it does depend. It does depend. But there are hopefully some guiding principles there that are helpful. No, none.
If you're going to take on money from investors, you have to be a Delaware C Corp.
Guiding principle.
If you're not, there's probably not a good reason to be a Delaware C Corp, but
double taxation.
Yeah. I think especially
more taxes, more funding.
When starting up, a lot of people don't realize, I shouldn't say this. Many people don't realize the tax benefits to losing money. And I hate to say it that way, but especially if as a pass through with an LLC, if you are doing this on the side, you have a full-time income, you're going to be able to write off your losses against your income. With an LLC, you can't do that with a C Corp. That is typical for the first year, 2, 3 of a company. You're not making income, overall. So there's a lot of benefits, even if you know you're going to do venture down the road. If you're not going to do it right away, start as an LLC. It's going to be way easier for you to it's been tax beneficial. It's going to be a lot easier from a lot of different perspectives.
Can you say that again? If you if you have a loss, one in the first couple of years of business, you can write that off as an LLC as a loss against your personal income. Is that right?
I'm not a tax attorney or an accountant. But the very, very high level, you lose $10,000 that year because you're investing your money, you don't have any income at all. You are able to write that off against your tradition, your income. Your income overall is going to be decreased for tax purposes.
Purely hypothetical.
In a vacuum, correct.
Excellent. Any other questions? Okay.